Hi, good evening, everybody. Nice to see you again on Finet SG with Xian. So we are very ready for this Finet SG with Xian, and it's episode 8 already, my friends. So it's still on mature and stable companies, and today I have a special feature to add on to what I want to share. Okay, so this is Xian, this is me. I'm in the business of investment risk management. So I've been a client of Unicorn for 5 years, since I was 25. And then from an asset of $25,000, I actually amassed $200,000 in 5 years. And because of 2 trigger events, mainly from my parents, 2 of them also from my parents, that really helped me and spurred me to be motivated to devote my life to really serve in business instead. So in the business of investment risk management, besides amassing these assets for myself, I also want to amass it for my parents and also loved ones and friends out there. So this is me, I'm Xian, and welcome to Finet SG. Well, just to share with you for our series is always like this, 20 to 25 minutes, and today there's a special feature and a bonus section on it to help you understand what is the purpose of my sharing today. Okay? So disclaimer is always shared, just to let you know it's for informational purpose. Even when I share an opinion, it's just solely my opinion. Anything you would like to know further on elaboration, just let me know. Come to me directly. Okay, I always begin with this question. How do you go about deciding how much you are actually going to invest? It's an important question now because everybody will be forced to invest at this point in time. And because if you don't do it, I will share with you what it means. If you don't do it, and your neighbor is actually the one investing, and your neighbor happens to be the one that selects the very good investment, then even if you're holding on to your cash, and if your investor, friend, neighbor is actually making a lot of money, 3-4 folds, you're actually on the losing end. So everybody is forced to invest at this time. And I'll tell you why. Because of the fact of the printing of money. And I will go deeper in that today. So economy update, I would safely share with you that there is not much difference here, but just a point to highlight. So congratulations to us, Singapore. We are having phase 2 reopening already since 19th of June. So I'm very sure some of you have already met your own friends and were hanging out, and as if nothing has happened and vaccine has found. So congratulations on that, on some of the business owners as well. They're able to really move on with their businesses, at least for a little bit, a start. The other thing to highlight here would be, I mentioned quite a few times in terms of the 4 types of companies, the structural losers. So SPH are the ones that in this category, and it's already removed from the STI, Straits Times Index, and is replaced by Maple Tree Industrial Trust. So structural losers, beware. How is it affecting us then? I also won't go so deep, just to share the year to date. So we're almost breaking even in terms of the market, in terms of financial market. I can share with you, because I shared with you quite a few times on the economy that has been going down, which is causing the disconnect to the markets. The markets are actually going back up, and it's due to mainly the printing of money, loose monetary equities. So this is what I mean. It declined 33%, it's going back up to 37%, simply because of that special date where they started to print money infinity. And they meaning the US economy, because we use them as a proxy to help us understand the impact, because they have the biggest impact to the world. Okay, so this is the changes in the equities market since 3rd June. So you can see in 3rd June is already quite volatile, I would say. It goes up 5%, then it goes down 8%, and then it goes back up. So here's my question. Would you guys be able to predict whether it will go up or down this time? Whether it's gonna help you to earn more money if you're invested? Or is it the best time to buy now if you're still waiting to time the market? It's very important because this is stretching to the first question I asked you, right? How do you go about deciding how much to invest? So if you are able to have this answer in your heart, or if you're not able to, then it's really something for you to ponder about. Okay? Question is, where do you think the market is heading to? I've shared since my blockbuster, since May 2020, that round 1 is almost over. Will there be round 2? Round 1 was really exhausting about printing of money. I shared with you already that the federal government from the US is actually printing $2.6 trillion, which is the same as what they have printed for a period of 6 years since the last crisis. So what they have done in 6 years since the last crisis, they have done it in 6 months. That's why I mentioned it's like Muhammad Ali, right? It's really trying to punch them through and give a knockout in the first round. But at the moment in time, I don't think round 1 is over. Okay, round 1 is definitely over, but I don't think that the opponent is being knocked out. So there will be a round 2 in my perspective. And the round 2 I've shared before in the previous episode. How would it look like? The resurgence of COVID-19 virus with reopening of economies. We have seen that in the US, we have seen that in Korea, we've seen that in Germany and China as well. So Singapore is not reopening. We're not sure, but there are really many ways to keep a lookout, because if they stop testing, it's also reducing the stats, right? So we can't tell. So how will round 2 look like? We don't know. And then slow recovery of consumption and business spending. So even if they were reopened, for instance, my mother is still asking me, you sure we can go out? I am not very confident. I'm not willing to do other things. So this is a real life example of even when you reopen the economy, not everybody is comfortable. It's not going to be like a rush to the movies, to watch even my favorite Wonder Woman movie. I wouldn't be very keen to rush there. So some industries will be permanently affected. I've shared before in the last episode where the global travels especially, if the companies can see that I can save 5 figures, tens of thousands of dollars, just by showing the same productivity by people going on Zoom meetings and Microsoft Teams meetings, why not? Why not I just invest a few $100s a month of subscription to Microsoft so that they can always deliver the same productivity? And with that, there's no need for global travels anymore, especially the business class. And that's really the bulk of where airlines are earning most. So with that change, will the airlines continue to earn the money? If you're holding on to any airline shares, will you be interested to find out whether airlines belong to which type of the 4 categories, and is it safe for you to hold on when round 2 is very likely? Okay, this is just an update from last week. So we see 7 states already rising because of reopening. And I'll move straight into case study because today I have a special feature, so I need to discuss this a little bit more, and still we'll need to stretch it to the next episode. So ST Engineering, very, very interesting. Stable and mature companies. Before we move on, we always have to understand this important investment decision. Thanks to my friends there, they have given me very good feedback. I chose to keep this slide for everyone because I've shared almost every episode, then I stopped sharing, and some of them were actually lost. So coming back to this, important investment decisions involve 2 things. First, understand what kind of assets you want to have. Assets allocation on the left side, where you look at the equities, the bonds, commodities, gold, and cash. So that talks about maybe the percentage and the weightage you want for your overall portfolio. The second one is when you talk about the selections on assets. And we are focusing on equities in Finet SG with Xian. So we talk about the 4 types always, because bonds will be something that is not actually easy to talk about now because of the low interest rate environment we're in, and also not very exciting, honestly. So moving on, I'm diving straight to ST Engineering, which belongs to the stable company, mature and stable company. And this is a very interesting one because it has quite a diverse customer segment. Okay, before we move on, start with a question, right? So that it frames you. Is it a good time to buy into mature and stable companies? So ST Engineering, a place where my father worked for 35 years before he was asked to retire, even when he doesn't want to. So that brings the importance of financial planning now. Okay, so business segments in ST Engineering. The biggest one is aerospace, where my father really used to work in. So in terms of that, they actually have contracts to do MRO, which is maintenance, repair, and operation. And that means it's mandatory to really service the aerospace vehicles, planes, definitely, after a certain number of times. So this actually reassures the revenue that comes in. Okay. Secondly, electronics. Electronics is really good because this involves a lot of government projects. Things like, even at this moment, is temperature screening, the signals that goes in, and autonomous drivers in Sentosa, where there are no drivers for their buses. So these government projects are actually helping the business to prosper as well. And ST Land. Land is about building the tanks and also for defense projects. So pretty strong. You know why later, I will share later. And Marine. Marine is a small part of ST Engineering, so I won't really touch on it. But these are the 4 sectors that we can look at when we think about ST Engineering and why they fall under stable and mature. I will share more later. So profit contribution by various segments. As you can tell, aerospace holds the most, 46%, electronics on 32%. So as I share, it actually reduces. You can see it for yourself. I want you to focus on the profits here. There's a total of 580 million profit after tax. So this is what ST Engineering is having now at this point in time. Most importantly, I want to also share with you how we actually analyze. One good friend of mine gave me a feedback that I really enjoy and help you to understand, okay, this is actually how we decide. First, we look at the past, looking at the 10 years profit growth, what has been going on in their dividends and the return on equity. Then we look at the present, whether COVID-19 is actually affecting them due to the business nature, or whether this pandemic has actually caused them harm. And then the future drivers. Of course, we want to know in the future what is going to happen to them to be further precise about their further growth, and also the share price that we look at to decide whether we want to have them in our portfolio or not. So we talked about this last week, ST Engineering per share. So it's pretty stable. I would say also very low. 13 years, only 22% of growth. So that's less than 2%, right, per year. And versus a cyclical company like DBS, they are also not growing very fast. But DBS one is something that we need to take care of in terms of it being cyclical. That means economy bad, this is no longer true. So return on equities I've mentioned is 26%. So as of last week, I already shared. So any questions, please come back to me. And the share price over time. So it is also like a weighing machine compared to its dividends. If the dividends are growing consistently, their share price will also grow at the same time. So it's no magic to understand that it actually grow over the last 13 years, 36%. So it's on a slight premium. And I will share with you later how it's going to affect during the COVID-19. So dividends per share is stable. That's of last week as well. And understanding it against the cyclical company, it goes down, yes, but still it will still be very stable in terms of dividends. And the share price this year, as of this year, it has gone down already. So basically that allows us to understand that the dividends are still pretty healthy. Yeah, just to be fair, 4.55% at a near zero interest rate environment, I would say is pretty good. So most importantly, so we come back to questions. How is ST Engineering's earnings be affected by the crisis? So looking at this financial statements from 2020, and ST Engineering, there's a record high order books that came in. So if you look at it, $1.6 billion of new contracts in the first quarter of 2020. And this new contract is actually worth 2 years of order book, which supports the near-term revenue. And you can see it's a slight increase, which is a hint to let you know that they're actually counter-cyclical due to the fact of customer segments, which I will share later. Okay, so $4.5 billion to be expected to be delivered in the remaining months of 2020. So at this point in time this year, they are still pretty healthy. And they are multi-year contracts, long-term customers, and I will share with you very, very quickly, very soon, who are the customers, which is why these long-term customers are keeping it very mature and stable. Because of this word, diversification. Okay, so diversification is a double-edged sword. At this point in time, I will just share that it has helped ST Engineering to weather the storm better. Because if you see from the left side, in terms of a region, you can see it's quite spread out. Asia is definitely the most, then US 21%, Europe 17%, and the rest of the world. And in terms of segments I've shared earlier, these 4 segments, they're actually quite diverse in that sense. And customer types, most importantly, if you can see, commercial, government, and defense. Commercial, in the next slide, I can share with you more. So in terms of the approximate revenue breakdown, 30% is defense. Normally, when it comes to economy downturn, defense can be very counter-cyclical. That means if the economy is bad, the defense is actually going up. Why? Because of the geopolitical tensions. So you're afraid that there might be so much tension that there needs to be higher defense, right? I wouldn't say it goes into a war straight away, but defense definitely needs to be more prepared. So this is actually quite a good, stable part of the revenue. And government projects. At this point in time, COVID-19, temperature screening is a must. And they are given quite a lot of government projects. So it's the autonomous bus that I'm talking about as well. So it holds 35% of its revenue. So I would say it's quite a strong and resilient revenue income that they have, the source that they have. So the rest is left to 35%. So which is why I feel that at this point in time, they are pretty resilient. So despite the lower revenue, I would say taking a look at it as a potential of a stock that holds dividends, then you can see it's still able to continue paying its dividends of 15 cents per share as per the previous 2 years. Because the comment has already set out by ST Engineering that the revenue will be lowered between 5 to 15% compared to the financial year 2019. So the drop of 15% will bring them back to the financial year 2018 figure. And what do I mean by that? Okay, so if you see the blue bar is actually the earnings per share, right? And the red bar is dividends per share. So you see from 2018, they have earned this amount and they have given the dividends like this. So 2019, even though they have earned more, but they still give the same dividends. That means it gives them the extra buffer that helps them and also be able to weather the storm like today. So this 15.75, right, in 2020 is actually already calculated in our terms, the projected 15% drop in revenue, and is still above what they can give as dividends, plus the buffer from last year. So in my perspective, it's easy to understand, or at least it's reasonable to understand that they will still pay the same dividends as of this year. So if you want to hold them as a dividend stock, I would suggest it's still okay. That's in my opinion, yeah. So what can we do? Okay, so here comes the special feature, right? The last week, I shared about seeking higher grounds by looking into your cash and gold and high quality structural growth companies. So today I talk about stable and mature. So what does it mean? Actually, when it comes to liquidity flooding the market, I've shared quite a few times what it means by QE infinity. This is the Marvel hero story, right? Where the government, the federal government, is able to print infinity amount of money to save the country. Okay, so this is what it means. And even the UE Bank is announcing 750 billion pandemic emergency purchase programs. So this is what I shared. Basically, the world is printing up to $5 trillion worth of money. But this money, in actual sense, it doesn't go to the man on the street, as I shared with you. So, and 90% of the world is using US dollars to trade. So they have no choice but to follow through. This is why when they're printing money, there is not much chance for it to go into hyperinflation, because the world is still trading. 90% of the world is still trading. Just that there are certain rules. The first rule is that they cannot give the money to the people. So second rule is that they can only give out loans. So they're not supposed to lose money. So they are supposed to only give out loans to companies who have heavy weightage in terms of their quality, and not the junk bonds and the near bankruptcy companies. But at the moment, they are printing money to save those companies and buying up junk bonds and also mortgage traded securities. So in terms of inflation, we should see another point. It's not just about printing of money that causes inflation, it's the velocity of money. And the velocity of money, if you take into consideration, it's just like you earning that $1 from this person, and then after that you buy another dollar of something from another person. That makes it already $3. So that $1 that came from you becomes that $2. So that is the movement of the money. As you can see from this world pandemic, there's not going to be much velocity, especially with 30 million people who are unemployed in the US. That is 25% unemployment rate. We're not sure what the rest of the world will face, but US is the first to face this heat. So with that unemployment rate, do you believe that they will be very, very quick to decide to spend the money? And if your answer is no, then the velocity is low. So that is the reason why I keep talking about QE infinity. Because I don't explain it further, so now I'm sharing with you now. Okay? And last week I talked about 3 bags of theory, right? So my friend also shared with me a very good feedback to share a little bit deeper of what it means. So when you stay invested, and especially when you are taking into consideration following Unicorn's portfolio, what happens when you're invested while you're still building your opportunity funds? I shared about this before. We hold one of the technology equities funds, and this is the one with the BlackRock. So now at the moment we are facing this increase within 3 months. 23rd of March is when we did the call, and then up till 18 June we faced this increase. So most importantly is how do you decide how much you're going to invest, right? Because at the end of the day, it's really creating wealth. And I would like to quote a little bit more after I ask this question. So in terms of the services, I always share with you, if you're not clear about what you should do with your portfolio, you can always seek a professional advice. And from there, I have already shared the outcome of what it means to do your homework and also do proper research. So if you do want support, or if you do want to at least hear what is there for you to manage your finances, these are the services that I can offer to you. Most importantly, it's really about achieving your financial objectives. And I always like to quote someone like him, Mr. Warren Buffett. Wide diversification is only required when investors do not understand what they're doing. So that we don't diversify for the sake of diversification. That is Unicorn's investment philosophy. So we always have one intention, is to create wealth. And only when we see the similar funds or stocks or counters that is following our philosophy, that we feel that, okay, it is fair and meaningful to diversify. So my friends here, never diversify for the sake of diversification. Okay, so if you have any questions, you can always come to me on advisory on cash flow management and budgeting, and advisory on optimizing resources to increase your overall returns on your assets. It's not just about going into an investment to earn more money, but it's really to understanding how to optimize your resources to increase your overall returns for your assets. So I will see you next week, and to share my final thoughts on ST Engineering, whether we are actually keeping them as part of our portfolio, and also helping you to understand and decide for yourself if you want to go on your own, whether ST Engineering is the right dividend stock for you. Okay? So if not, thank you very much. If you have any questions, this is actually the QR code to a questionnaire that I've built just for you. If you have any questions and you're a little bit shy to understand what I can do for you, please feel free to take this QR code and state your questions. Then I'll be in touch with you, either by a Zoom session, or rather, if you're shy, we can just talk about it through WhatsApp. Just let me know. Just directly contact me. If not, I will see you next week.